Marqeta is currently worth $6 billion. Earlier this year and last year, it was worth much more than that. Do we think that it's starting to become an attractive valuation?
Yeah, and I think that it's pretty attractive here at about 11 times price to sale multiple.
Yes, it's gotten cheaper. Is it cheap? No, not on a free cash flow or an earnings basis. There are none. Cheaper, but you still have to make the call if you're going to buy the stock that estimates are too low and that the business is fundamentally improving. And that's for someone to do their deep diligence. And it sounds like Jared's done the work and says estimates are too low. He knows the company well. I think that's a valid reference point.
Welcome to Alpha Bets, a weekly conversation where we dissect interesting companies and help you understand the investment thesis in about 12 minutes. I'm joined today by Ross Klein, the CIO of ChangeBridge Capital, Pat Connolly, our resident stock detective, and Jared Simons, research associate at Beating the Market. I'm Nathan Warden, and it's time to talk Marqeta. What does Marqeta do?
Marqeta is a modern card issuing platform. So debit cards, think Apple Wallet, the cards in your Apple Wallet. Marqeta powers that. They basically bring payment solutions to life. I like to refer to Marqeta as the power of pay. The current payment processing system, it's very complicated to enter the Visa and MasterCard rails.
Can you describe the Visa rails?
Great question. The Visa network and MasterCard network is pretty complicated. There's 4 parties, an acquiring bank who acts on behalf of the merchant, as well as the issuing bank who issues you the actual card. So what Visa does is it plays the messenger between the issuing bank and the acquiring bank. What Marqeta does is they play the role of the issuing bank. They basically are the connector to the Visa and MasterCard rails. They let companies like DoorDash, Affirm, or JP Morgan connect with the rails of Visa and MasterCard and launch their solutions. They let companies come in and drop their payment solutions into the platform.
I guess my first question was, how important is scale in this environment? If you're going to be offering an API for developers, is your workforce big enough to compete with the other companies offering APIs for similar solutions? Is scale the number one thing that will determine the winner in the end?
Marqeta is already in 39 countries. And once a customer is using the Marqeta platform, it's very easy to deploy a new solution in new regions because it's all controlled from the Marqeta platform. So Square recently launched its Square card, which is on the Square seller side, and they just brought it to Canada. So Marqeta enables them to seamlessly scale in Canada and in more regions where they're going to enter. That's the cool thing about Marqeta is that it enables its customers to grow at scale, and Marqeta grows alongside with them because as they process more volume in those regions, Marqeta takes a percent of that as well.
So Ross, why is card issuing so challenging at scale?
Legacy, it's been a few massive competitors, and it's been hard for new entrants to come in from a regulatory perspective and a complexity perspective. The legacy banking system, which we're all effectively looking to evolve, it has made it prohibitive for new entrants to come into the market. The fact that Marqeta is even here is quite impressive and surprising, frankly. It is a business model with, on the card issuance side, not necessarily on the payment processing side, but on the card issuance side, it's a business model that has tough margins. And it's not a business model where you have a lot of pricing power. Historically, there haven't been a ton of new entrants, and those who have entered have had a hard time going up against the incumbents who a few players dominate the industry. From a regulatory perspective, it's tricky. From a geographic perspective, you're looking at different interchange networks in different countries. It's a lot harder to grow and expand outside of your original country.
It's a very good point. And the regulation in the US is a lot different than it is in the UK. And what's interesting in the UK is that they recently launched there. Their business is growing pretty fastly there, but they also operate a different interchange model. In the UK, where interchange rates are capped and they're much lower, Marqeta is able to operate off of this transaction-based pricing model. I think that the companies that Marqeta is enabling just highlight the need for the change in the regulation.
What kind of future fintech innovations are enabled with Marqeta?
So the expense management vertical is definitely a great place to start. Basically enabling their customers to use their funds instantly, whether that's through a debit card solution or enabling employees to be paid faster or receive invoices faster. It's basically able to customize the spending controls and organize it so that the right people are spending the right amount at the right time. time.
The business use case that I was really the most intrigued by was like payroll management and employee management and like Uber delivery. I thought that's brilliant. That makes a ton of sense. Pay those people faster. They're happier. You've got more control. Like, duh. I love that.
How does Marqeta stack up with other competition like CoreCard?
CoreCard doesn't have the open APIs. They're more of a program manager, where Marqeta basically gives the keys to its customers.
And any specific thoughts on Galileo and Sofi being a competitive threat to Marqeta?
Yeah, Galileo was founded in, I think, early 2000s. And it was a legacy system. They switched to the cloud in early 2021. And the customers that they are empowering, they are enabling basically these finance hubs communities, and they're not really powering these mission critical payment solutions.
On the competitive front, I'd be more worried about Stripe and Adyen getting into the market for processing than some of the legacy guys and even some of the other newer entrants. Because Stripe, for instance, they're best in class at what they already do. And they do have a bit of a unique position to be a pretty powerful issuer as well. Now, not to say that they do seem to be taking steps to move more aggressively in that space. Is that something you think much about?
Stripe is really on the acquiring side. So Marqeta is really on the issuing side. It's pretty hard to do what Marqeta does on the issuing side and offer so many features, whether that's just-in-time funding, converting crypto to fiat at the point of sale. There's a lot of components and a lot of data that's injected.
I would follow up though with, if there's such a large competitive edge, why are we seeing take rates continue to decline? Now the rate of decline is stabilizing, but like they are still shrinking.
Yeah, the way that the founder of Visa, D-Hawk, envisioned the payment system to work is that fees are supposed to go down over time. They shouldn't be increasing. Marqeta's real advantage is that it continues to add solutions and it continues to enable its customers to deploy at scale all over the world. So by doing that, Marqeta is able to increase its customers' total processing volume, while Marqeta will stand to still benefit as it is able to offer them lower fees.
Marqeta's dollar-based net retention rate is incredibly high, like 200%. It's a headline number, super impressive. Have hardly heard of numbers that high for that metric ever. Do you have any reservations on that number? Does it bring up more questions than answers for you? Or are you very impressed by that number?
I'm impressed by the number, but I don't really think it's the appropriate metric to be using. I think it's more of a way of measuring the activity of their end users. But yeah, it's a good, if you want to keep it consistent, it's a way of tracking the overall activity of their users.
It's not the best metric to look at. I think that their non-top 5 customers revenue contribution is a little more important. That was 228% last quarter, and that continues to increase, illustrating that as Marqeta's other customers grow, they are going to become less reliant on Square. But in terms of the net dollar retention, it just illustrates that as customers use Marqeta, they usually continue to implement it in more ways.
70% of Marqeta's revenue comes from Square. How worried are you that this is a huge risk?
It's a huge risk for Marqeta. There aren't any signs that there's a problem with the relationship that they have with Square. They're partnering on new ventures, which is a great sign. But the contracts do start to expire in, I think, March of 2024. And it appears that the take rates that Square is paying Marqeta are meaningfully higher than the take rates Marqeta's other customers are paying. And so perhaps the risk isn't necessarily in that they'll lose Square, but there is a real risk that pricing gets cut. And if it's a 70% customer and pricing gets cut 15, 20, whatever percent, that's a big deal for a company that's expected to grow meaningfully for a while.
More than 10 teams at Square are building on the Marqeta platform and using it every day. So Marqeta's platform is definitely heavily ingrained into Square's ecosystem. And Square is using the Marqeta platform to expand and scale into new regions. So over time, I look at it as the more that Square builds in the Marqeta platform, the more Marqeta is meaningful to them. And over time, their dependence on Square is going to evaporate, as Square is an illustration of what each and every other customer has the opportunity to become.
If you go back and look at Twilio messaging processing, They lost a large customer and the rest of their other customers were growing rapidly. But the day that they lost that big customer, and I'm not suggesting Marqeta loses Square, but the day that happened, it was a meaningful shock to the stock. And it wasn't a 70% customer. We're talking much, much smaller. If you're thinking about potential risks, that is a real potential risk. But if they're able to have the event where they extend the contract and perhaps pricing comes down and numbers get cut, your biggest risk is taken off the table at that point. And investors might look to that as a potential opportunity. I don't know when it would happen. I don't know how it's going to happen, but the biggest risk today is the biggest opportunity in the future. So it goes both ways.
What are you impressed with in Marqeta?
Winning the business with JP Morgan and Goldman are big deals. They didn't go with the legacy banking system for this. They went with Marqeta. I think that's a pretty good indication that they're building something that adds value. It's worth something. Whether today's valuation is right or not is a different debate, but I think that's a big deal.
Let's talk a little bit of valuations. Marqeta is currently worth $6 billion. Earlier this year and last year, it was worth much more than that, 17, maybe might even hit close to 20 billion. It's down 64% since it IPO'd in June of 2021. Do we think that it's starting to become an attractive valuation, or is it just coming down to earth in a way that it should be?
Yeah, I think that it's pretty attractive here at about 11 times price to sale multiple. They report earnings in about 3 weeks. I'm expecting them to do about 510 mil this year, expecting a pretty strong year next year, expecting about 55%, mid 50 to lower 60% year over year growth in 2022. So yeah, what I'm going to be looking out of for Q4 of 2021 is basically, can they get back to that upper 60% year over year? I think that it's easily possible, and especially what we've seen out of the expense management vertical from Bill.com so far out of the recent earnings report. But looking into the next 3 to 5 years, I think revenue growth is easily 50% plus.
I won't speak to the specific estimates. The valuation is still pricing in years of future performance. So you might have gone from pricing in X number of years 6 months ago, and now you're pricing in X minus some number. So yes, it's gotten cheaper. Is it cheap? No, not on a free cash flow and earnings basis. There are none. Cheaper, but you still have to make the call if you're going to buy the stock that estimates are too low and that the business is fundamentally improving. And that's for someone to do their deep diligence. And it sounds like Jared's done the work and says estimates are too low. He knows the company well. I think that's a valid reference point. One possible concern is a lot of their customers were COVID beneficiaries, and there could be somewhat of an air pocket as we lap that. But I'll argue with myself here and say that I think one of the lasting COVID losers that we don't spend a lot of time talking about is cash. And they benefit as cash goes away. And it's just another two-sided debate for people to think about with this stock. And the more of those that there are, the harder it is to get on board with clearly a growth company where earnings are on the come and there's no free cash flow and you don't really have a valuation basis quite yet on an earnings or free cash flow basis. But demographics wise, they're in a good spot as long as they can continue to execute, I think.
Any other predictions you want to make about Marqeta?
Yeah, I think that the banks are the next customers. I think that the expense management vertical, they've recently acquired a lot of customers, and we're going to start to see a lot of those solutions rolled out. But these regional banks and these other large banks, I'm really interested to see the partnership with First National Bank of Omaha and how they implement the Marqeta platform at JP Morgan and Goldman Sachs.
All right. Thanks so much for tuning into Alphabets. If you enjoyed this discussion, make sure to check out our other conversations on Open Door, Corsair Gaming, Robinhood, and many others. Thanks a lot, and see you next time.